Good day. In this video, we will take a look at employees' tax. Employees' tax is not an additional tax, but merely upfront payment of an employee's normal tax liability on remuneration end. Employees' tax is required to be withheld monthly from remuneration that is paid or payable by an employer to an employee in terms of the fourth schedule to the Income Tax Act. So anything related to employees' tax you will find in the fourth schedule. It is paid over monthly to SARS by the employer, and on assessment, the employee's normal tax liability is reduced by the employee's tax that has been deducted from his remuneration during the year. All of these three elements must be present for employees' tax to be withheld, meaning there must be an employer who pays remuneration to an employee. In simple terms, there must be an employer-employee relationship. In the next slide, we will discuss each of the definitions of these three elements as they are very important. Again, those elements are remuneration, employer, as well as employee. So who is an employer? This is a person, excluding an agent, who pays remuneration and any person who is responsible for the payment of remuneration. Who is an employee? An employee can be any of the following. That is, a person that receives or accrues remuneration except a company, a person that receives or accrues remuneration by reason of services provided to or on behalf of a labor broker. A labor broker. What is a labor broker? This is a natural person who provides clients with his own employees to perform work for the client or procures workers for the client. An employee can also be a personal service provider. What is a personal service provider? A personal service provider is any company or trust where you have a connected person that is a natural person personally rendering the services on behalf of the company or the trust. An employee can also be a person declared by such by the Minister of Finance in the Government Gazette, as well as a director of a private company. Remuneration includes income that is paid or payable to a person, whether in cash or otherwise, and whether or not for services rendered. Remuneration includes 13 types of income plus 16 specific inclusions, and it excludes 4 specific amounts. Now let us look at a breakdown of the 13 types of income, the 16 specific inclusions, as well as the 4 amounts that are excluded specifically from remuneration. Right? The 16 types or the 13 types of income is a salary, leave pay, wage, overtime pay, bonus, gratuity, commission, a fee, emolument, pension, superannuation allowance, retiring allowance, as well as a stipend. So these are the 13 types of income. The 16 types of amounts that are specifically included in remuneration are your annuities, amount with regards to services rendered, including any voluntary awards in terms of paragraph C, retirement lump sums, as well as retirement withdrawal lump sums, Retirement fund lump sum from an employer. So in the third specific inclusion, this would be lump sums from the funds. The fourth one would be the lump sum from the employer. Conversion from a public sector pension fund to a private or to a public provident fund will also be included in remuneration. A restraint of trade payment, commutation of an amount due under a contract of employment or service, 80% of the travel allowance. 80% that is referred to here is the travel allowance that a person would receive. So that is the gross travel allowance. This is before taking into account any deductions for business expenditure, right? If, however, the taxpayer has traveled 80% or at least 80% of the kilometers traveled is for business purposes, you will not include 80% of the travel allowance, but you will include 20% of the travel allowance that is received. Right? So you will make this determination of whether 80% or more was traveled for business purposes by looking at the records of the travel, of the kilometers traveled. Allowance or advance included in taxable income under Section 8.1. Other than a travel allowance, subsistence allowance, or an allowance granted to a holder of a public office, because these are specifically included, so they are not accounted for under this paragraph. This can be, for an instance, your computer allowance or your cell phone allowance, right? Number 10 of the specific inclusions is your subsistence allowance. Remember I said this has its own specific inclusion. And the subsistence allowance is only included if the employee does not spend a night away from his usual place of residence, right? So if they were given the subsistence allowance because they were anticipating to be away from their usual place of residence and they ended up not going away, that subsistence will be deemed to be remuneration in the following month after the employee did not go away, right? However, if the employee was given a subsistence allowance and they did indeed go away for business purposes from their usual place of residence, that subsistence will not be included in remuneration. So it's not part of remuneration. It is only part of remuneration if the employee does not spend the night away from their usual place of residence. 50% of the allowance given to the holder of a public office will be included in remuneration. If a taxpayer receives a reimbursable travel allowance, only the portion that is deemed to be excessive will be included in remuneration. Right? So anything that is not excessive will not be included in remuneration. So how do we determine the amount that is excessive? We look at the difference between the rate that has been paid versus the simplified rate. 80% of the taxable fringe benefit for the right of use of a motor vehicle. Now, for this part or for this specific inclusion, please note that the taxable fringe benefit that is referred to here is the value of the private use less the consideration made by the taxpayer. So this is before you make deductions for any business travel, right? In terms of paragraph 7 of the 7th schedule, right? And then if 80%, similar to your travel allowance, if 80% of the kilometers or more were traveled for business purposes, then you will only include 20% of the taxable fringe benefit and not 80%. Right? If less than 80 kilometers of the kilometers traveled were traveled for business purposes, then 80% of the taxable fringe benefit will be included in remuneration. The 14th specific inclusion is any other type of fringe benefit excluding right of use of a motor vehicle, because we have already accounted for that in the 13th specific inclusion. So it's any other thing like your right of use of an asset, for example, right? And then any gains on qualifying equity instruments in terms of Section 8C will also be included in remuneration. And then lastly, any amount that is received in terms of a maintenance order, that is your Section 711, is specifically included in remuneration, right? So if you see, if you look at some of these specific inclusions, you will see that there is not necessarily an employer-employee relationship in most of these cases, or in some of these cases, but it does not matter because these amounts are specifically included. That's why they are specifically included, because if you only referred to the general definition of remuneration, you would have not necessarily included these amounts in remuneration. But because of these, this specific inclusion, then you will include these amounts in remuneration. Right, remember we said there are 4 amounts that are specifically excluded from the definition of remuneration, meaning any of these amounts will not be included in remuneration. And the first amount that is specifically excluded from remuneration is any amount that is paid to an independent contractor in respect of services rendered, any amount that is a government pension, and any grant paid under the Aged Persons Act, the Blind Persons Act, the Disability Grants Act, as well as the Children's Act. The third exclusion is any amount that is paid to an employee wholly in reimbursement of expenditure actually incurred by him in the course of employment. If you think back to your reimbursive travel allowance, we will only include the excessive amount, because remember, reimbursive is where you have already expended whatever expenditure for business and you are claiming it back from your employer as an employee, right? So if you are claiming back that expenditure, we refer to, or we call it, a reimbursive expenditure. So you incur the expense first and then you claim it back from the employer, right? If you have expended, or if you have incurred that amount for business or for trade purposes on behalf of the employer, then that amount is excluded. That is why we only, if you think back to the reimbursive travel allowance, if you think back to that reimbursive travel allowance, only the excessive portion will be included, and that is a specific inclusion in remuneration. And then lastly, any annuity under a divorce order. Remember, the specific inclusion referred to a maintenance order. Now, the specific exclusion is an annuity under a divorce order, right, would be excluded from remuneration. If an amount is not remuneration as defined, then employees' tax is not applicable. The definition of remuneration is therefore very, very important. Once it has been determined that a taxpayer is an employee and an employer-employee relationship exists, the following steps will be followed to calculate the monthly employee's tax. Step 1, you determine the remuneration. So you go back to the definition. Is the amount that you are looking at one of the 13 types of income? If not, is it one of the 16 specific inclusions, or is it an amount that is specifically excluded from remuneration? That's the first step. Step 2 would be to calculate the balance of remuneration. We will refer to that, or we will talk more on that on the next slide. If the balance of remuneration is for a period less than 12 months, then the third step is to calculate the annual equivalent remuneration. When calculating the annual equivalent remuneration, it is important to note the period in which the amount was received. Remember that any variable remuneration will be included in remuneration in the month that is paid, and that is in terms of section 7 capital letter B. Please also note that annual payments, including variable remuneration, are added to the annual equivalent remuneration and not the monthly amount. And the reason for this is simple. These amounts, your annual amount or your variable remuneration, is not received on a monthly basis. So you cannot include these amounts in your monthly amounts. So once you have calculated your annual equivalent, which would consist of your monthly amount multiplied by 12 months, then you will include your annual amount or your variable amounts, because these vary or these are received once in a year. Okay. The fourth step would be to calculate the taxation on the annual equivalent remuneration according to the tax tables, taking into account Section 6 rebates, Section 6 capital letter A rebates, and only if the taxpayer is 65 years or older will you take account the Section 6 capital letter B medical credits into account. Right? I will repeat this because this is very important. So when you take into account your rebates, your Section 6A or your medical credits, you will only consider the 6B, your additional medical expenditure credit, only if that taxpayer that you are calculating the employee's tax for is 65 years or older. If they are not, or if they are younger than 65 years, you will only consider your Section 6, that is your primary rebate, as well as your Section 6A medical credits only. That is if the taxpayer is younger than 65 years. Right. The reason we need to convert the monthly remuneration into an annual equivalent is because the tax tables that we need to calculate the normal tax on the remuneration is drawn up for annual income. Right. And then the last and fifth step is to calculate the taxation for the period of service. So you need to look at what you are required to do. If you are required to calculate the employee's tax for the whole year, then you will not need to divide the amount that, or the amount that you get in step 4 would be your final figure, right? If you are, however, required to calculate the employee's tax for a specific month, then you will need to take that into consideration, and therefore you will get to step 5. The balance of remuneration, which was in our second step there, or we say it, refer to the next slide. The balance of remuneration is your remuneration less the following deductions. So the first three deductions are your retirement contributions. So they are as follows. The first one would be any contributions made by the employee to a pension fund or a provident fund limited to Section 11 capital F. So the same way that you calculate your Section 11F, those principles, you apply them here, except one minor change. We will discuss it now. Right? Any contribution to a retirement annuity fund made by an employee, and this deduction will only be allowed if the employee provided the employer with proof that they have or they are making this retirement annuity contributions. So if the employee made a contribution to a pension fund or a provident fund, then they don't need to provide proof to their employer. However, if they are making contributions to a retirement annuity fund, then they need to provide proof to the employer that they are making their contribution for them to have this deduction, or for this deduction to be considered in their employee's tax calculation. The third deduction is any contribution made to a retirement annuity fund by the employer on behalf of the employee. So in this case, you just think about, or go back to the basics. If the employer is the one that is making those retirement annuity fund contributions, then they have access to this information and they can use it in their calculation, right? If you make, as a taxpayer or as an employee, if you make contributions to a retirement annuity fund and your employer is not aware of these contributions, then they don't know this information and they can't therefore use it in their calculations. That is why if you do not provide proof to the employer that you have made contributions to your retirement annuity fund, your contributions will not be taken into account in your calculation of employees' tax by the employer. The last deduction is any donations made by the employer on behalf of the employee, limited to 5% of the remuneration after deducting retirement fund contributions, and the employer must have been issued with a receipt as contemplated in Section 18A. So meaning this deduction is only available if the employer made a donation to a public benefit organization, your PBO. Please note that this deduction is only applicable if the employer and not the employee made the donation. Right? And that is for the same reason that if you as an employee made the donation to a public benefit organization, then your employer is not necessarily aware of the donation that you make, and therefore they will not have this information at their disposal for them to take it into account in the calculation of your employees' tax. Please look out for the next video containing an example of the basic employees' tax principles discussed in this video. Thank you.